Most people believe successful investing comes from brilliant ideas, fast decisions, or predicting what comes next. Welcome back to the FinDecode. Let's decode the timeless framework behind that quiet success. The billionaire investor Monish Pabrai, he doesn't really mince words. He says the world is just overflowing with ideas, but true value, that comes from masterful execution, and sometimes the best idea to execute is one that's already out there, proven to work. So this isn't a story about lone geniuses who came up with some radical new method. No. It's about a few incredibly disciplined investors who just studied the greats, found a single timeless principle that resonated with them, and then applied it with almost perfect consistency. Let's break down 3 of the core principles they absolutely mastered. Okay, so the first principle, it has nothing to do with stock charts or trying to time the market. It's about something much more fundamental. It's about understanding what you're actually buying, a small piece of a real, living, breathing business. This slide really gets to the very root of Warren Buffett's entire philosophy. See, investors like Monish Pabrai figured out that to understand Buffett the investor, you first had to understand Buffett the kid. These weren't just a bunch of random odd jobs. They were his first lessons in cash flow, in allocating capital, and in human psychology. This stuff is what shaped his entire worldview on investing. And what that does is it creates this incredible feedback loop. When you understand how to squeeze a weekly profit out of a single pinball machine, it gives you a totally different way of looking at a billion-dollar company. It grounds your perspective in real-world operations, not just, market speculation. So you're thinking like a business owner. That's a huge first step, but even the best business owner in the world needs capital. And that brings us to our second principle, finding a powerful, sustainable financial engine to fuel your ideas over and over and over again. This right here, this is the secret sauce. Warren Buffett had this huge insight. An insurance company gives you access to a massive, continuous pool of other people's money, the float. You can then invest that float for your own benefit. It's kind of like getting an interest-free loan that you might never have to pay back all at once. An investor named Prem Watsa saw this and immediately recognized it for what it was, a financial engine that he could copy. And the result is, it's just staggering. Watts' story is a total masterclass in focus. He didn't need 100 new ideas. He just needed one powerful one that was already proven to work. He found Buffett's engine, bought a company to put it in, and then he had the patience to just let it compound for decades. That's how you turn $50 into a multi-billion-dollar empire. All right, our third and final principle, and honestly, this might be the most important one of all. It's not about maximizing your gains. It's a defensive strategy. It's focused entirely on minimizing your losses. Investor Seth Klarman built his entire legendary career on this one idea, which, by the way, he copied from Buffett's own mentor, Benjamin Graham. The heart of it is this: simple. If you think a business is truly worth $1, you never, ever pay $1 for it. You wait. You wait patiently until you can buy it for 50 or 60 cents. That discount, that's your margin of safety. It's your cushion in case you're wrong. And that philosophy, it sounds almost exactly like Buffett's famous rule, right? Don't lose money. It's a complete flip of the typical Wall Street mindset. See, the best investors aren't really risk takers. Klarman would argue they're masters of risk avoidance. And this chart right here, it shows you what that looks like in the real world. During the 2008 financial crisis, when the S&P 500 was in an absolute freefall, down 38%, Klarman's fund was only down single digits. His margin of safety worked perfectly, protecting his capital right when fear was at its absolute peak. So if these principles are so simple and so effective, why isn't everyone a billionaire? Well, the answer, it turns out, has less to do with strategy and a lot more to do with our own psychology. Most of us are just wired for action. We see the headlines, we check our portfolios, and we feel this overwhelming urge to do something. But the truly great investors, they are masters of disciplined inactivity. They have the patience to sit on cash, sometimes for years, just waiting for that one perfect opportunity, what Warren Buffett calls the fat pitch. They understand that a lot of the time, the smartest move is no move at all. And it's so important to realize this isn't some kind of personal failing. It has nothing to do with intelligence. Our brains simply evolved to react to immediate threats and opportunities, not to patiently compound money over a 50-year timeline. So to overcome this, you need more than just knowledge. You need a whole new mental framework. So this brings us to the final practical takeaway. And this isn't about giving you direct advice, it's more of a thinking tool, something to help you find your own way of looking at the world. The goal here isn't to try and become the next Warren Buffett. It's to find one of these timeless ideas, thinking like a business owner, finding a financial engine, demanding a margin of safety, and pick the one that truly clicks with your own personality. Are you an analyst at heart, a defender, a builder? Once you find your principle, then the real work starts, applying it with a patience that has to feel almost inhuman at times. Because in the end, the path to great returns, it usually isn't paved with brilliant new inventions. It's a much quieter path. It's marked by the discipline to find what works and the patience to just stick with it year after year after year. Good investing is rarely exciting, and that's usually why it works. Hope we decoded this correctly.